Welcome to Decision Time. I'm Karen Cho. We are counting down to the ECB's latest rate decision. The central bank is expected to deliver its first back-to-back rate cuts in 13 years, with markets pricing a 25 basis point move lower today and again in December. The data released this morning shows further easing in Eurozone CPI. The final reading of the September inflation print came in at 1.7%. That is, of course, below the ECB's 2% target for the first time since June 2021. On the month, CPI declined by 0.1%. A look at euro dollar, you can see on your screen, it is fairly stable and it has been in session today, 108.63, where we're hovering, but there's been a fairly steep decline since about late September. So that dollar strength very much magnified at this point versus some euro weakness, concerns around the growth profile, clearly in front and centre for a lot of FX traders. Now, a look at how we are shaping up on those yields as well at the 10-year basis as we count down to this all-important decision today, and just whether there is any further guidance or anything that moves the needle on some of these yields. The 10-year bond, we're travelling just shy of 2.2, so we're 2.19%. OATs in France at 2.93%, so perched high across the board. The Spanish yield 2.91%, and on Italian paper we are sitting at 3.40%. To the European markets, it's been a fairly hefty day today on the earnings front as investors get a close-up look at some of the fundamentals of these companies, and that is from consumer goods to drinks companies and beyond. And so far we've had a French market that has been leading the charge higher, up more than 1%. Versus more subtle gains on some of these other major markets. Italy's been trying to keep pace, so that has been a solid performer today. The Xetra DAX up 0.6%, but the IBEX trailing behind in a slightly negative territory today. So we are setting up, though, for a shift in focus now this hour to a macro picture. We've been very much closely eyeing what could be another 25 basis point rate reduction, but without much guidance. So let's get out to Annette Embardo. She's in Slovenia, where the ECB is meeting this month. Annette, take it away for us. Just what sort of reduction are we looking for? Because the market, I believe, is not expecting to get much of a glimpse into the runway from here.
Yes, that's sadly, I have to say the truth, that the ECB probably won't give a lot of guidance as of today what happens during the next couple of policy meetings, and they will reiterate their phrase that they are data or data set dependent, and they will make their decision every single meeting. But looking through the data, I think one can have a clear idea of what the ECB probably has to do, and that is cutting rates on a regular basis, given that inflation now has also disappointed with a now final reading of 1.7% for the euro area, and that economic growth seems to be really drastically lower than previously expected by the ECB. So we won't get a new round of staff projections today from the central bank, but what we're expecting is that they give us kind of an idea of what they actually think about the status of the economy and also how reliable the reduction or the coming back of inflation to the target is. Any hint that there is a risk of undershooting for the inflation rate could give the market even more ammunition to really think that this rate cutting cycle will be now a very steady one. Whether they will at some point in time go as far as 50 basis points remains to be seen, and that will also be dependent on new wage data, which we'll get for the fourth quarter for the euro area, because that's a very important factor for the ECB. They call it domestic inflation, and that's mainly dominated or mainly determined by wage developments. We're seeing layoffs not only in the manufacturing space across the euro area, and that could mean that wage pressure is really seriously abating and that inflation thus also will come back. And the risk is actually that the ECB will not fall substantially below its inflation target, because then they would probably have to cut even more and stronger than they can do it now. So that is kind of on the table today, I would say, especially a hint on undershooting, more on what they think about economic growth will be crucial. And perhaps, of course, the obvious question, what they think how independent they can act from the Fed's policy, and how the Fed's or the United States is different from the euro area, because it seems that inflation there is here to stay and it's more entrenched than here in Europe. So I guess this is the data mix we are looking at, and Christine Lagarde will need to show some sort of confidence that she's ahead of the game, which I think she lacked to do during the last policy meeting and press conference. There was a lot of talk about uncertainty, but no clear guidance, I would say, or leadership when it comes to the ECB.
Thank you very much for setting the scene for us, Annetta, and it certainly marks a change from looking at Frankfurt to see the conditions there on the ground in Slovenia today. I've got Mariana Sina, who is with the Barclays, Senior European Economist at Barclays Investment Bank. Thank you so much for joining us today.
Pleasure to be here.
I think every bank is now looking at what the ECB is doing at this hour, and I was looking at the inflation rate, and this has been quite key because it's clearly been a hurdle for some over at the ECB to embark upon further reductions. But, you know, the data today showing us that we are far and away from where we were even same time a month ago. We were tracking 2.2%. We were not back at target. Today, the 1.7% level we have for the euro area suggests, look, we're not even at target. We're now under target. So how compelling is that?
I think it's very compelling. It's a significant factor is that you mentioned where we were 1 month ago, but I would say that in 2 months, headline inflation has come down 90 basis points. And also when you look today into the data, the final release, what you realize is that underlying inflation is coming down fast. When you strip, for example, from services, the volatile components, like accommodation or package holidays, is that month on month, seasonally adjusted, is running almost at 2% right now. So it's a big, important and big factor in the decision.
Yeah, a lot of these components, we're seeing it from travel, where some of that heat is starting to abate, the Taylor Swift effect around those concerts that everybody seemed to book, no matter what the price was, to some of the big sporting events, the Olympics,
Exactly.
all in the rearview mirror to an extent. In terms of the services side, and this is the aspect everyone says, oh, look, the core's not coming down quickly enough, we've still got heat in the core, but do you think we are seeing a significant deceleration now in services inflation?
I think that we are in the initial steps of this process. Is that everyone is worried, like when we speak in Barclays with our clients, they're worried about the resets. In January is that we know that insurance companies, health companies, is that you have a repricing once a year and it takes place at the beginning of the year. So I think that we are cautious on that. But beyond that, I think that it's clear that this inflation in services is already in train. And I think that is fundamentally driven by the weakness in economic activity on the labor market.
Early in the year, when I spoke to pretty much half of the governing council when we were in Washington, there was a view that some of the members were starting to get very concerned about growth. But effectively now what we've had, a growth slowdown, the powerhouse of Germany, we talk back-to-back recession on an annual basis. Just how weak is the economic story, and how worried should the ECB Governing Council be?
I think that when you read the accounts of the September meeting, is that you realize that they were significantly more worried than what they let us know at the meeting. And I think that there's clearly divergence. You have countries like Spain and the Netherlands that are doing well, but for example, Germany, as you say, is struggling. So they're getting worried. Is that for us is that we don't see a risk of a full-blown recession. I think that the risk is more of stagnation, where domestic demand does not pick up and remains basically lackluster.
Yeah, I know the closer you got to the border with Ukraine too, a lot of the ECB members were concerned about how the geopolitics played out and whether that could also undermine growth. I want to get to the guidance, because being a non-European, it does jump out to me that there is a European way things are managed. And today we may not get too much guidance, but yet the market is setting up for pretty much 25 basis points in reductions as far as the eye can see. If that is the case, why not just get on with it and deliver a 50 basis point rate reduction? The Fed has already proved that you don't necessarily spook the market if you do that.
I think that the ECB is an institution that they like to proceed gradually. They try to work with consensus within the governing council members, is that you have different countries. And I think that the important for them is that they have a strategy that they can react both ways. And I think that that's why 25 basis points at this meeting is that the reasonable assumption. For us, the bar for 50 basis points is very high. It could be driven in scenarios where we really are concerned about the risk of inflation falling below target for a sustainable period of time, or if we see a deterioration in the labor market that so far on the surface remains resilient, but under the hood there's already some signs of softening.
I think that explains it, because I did hear the other day someone saying, look, they're behind the curve. And if that's the case, you would talk about any other central bank would be talking about a different move today. But it does sum it up and sort of sets the scene for us. Mariano is staying with us. Mariana Sina, who is Senior European Economist at Barclays Investment Bank. We are now just minutes away from that all-important announcement from the ECB. We'll bring you the decision right after the break.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
CNBC. Live ambitiously. Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. cnbc.com/technology.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
We are now just minutes away from the ECB's rate decision. A quick check on how euro-dollar is performing at this hour as we set up for the announcement to hit the tape. We have been fairly even keel on euro-dollar rates this morning. You're looking at the stock market, of course, where we've seen some green, but we're 108.62, so we are really flat as we waited out for this decision. Now you can see really no movement, but the movement has come in prior weeks. We've moved very aggressively off the high water levels as dollar has rebounded thanks to some strength in the data. And managing, of course, expectations around what comes next. So you can see we're 108.62. In terms of what we're seeing elsewhere on those yields, we have been leaning higher on some of the yields. On bonds, 2.19%, 2.93 on paper out of France, and you can see on Spain, 2.9 versus a slight dip on paper out of Italy, 3.40%. European markets, it's been a fairly significant day on the earnings front, and we are digesting a lot of fundamental news, and that has moved the needle on particularly the French stock market today, where there's actually been a lot of bad news in recent sessions. So it is a trade to the upside today, real recovery trade taking place as we get a bounce, tracking at this stage 1.25% higher and leading the way forward for Italian stocks. German stocks up 0.7. The market out of Spain somewhat soggy today. We are getting ready for the ECB decision at this hour. And of course, the big move is whether we see that deposit rate move from 3.5%. We see that move lower. We're watching the other main rates, the main refinancing rate, the marginal lending rate as well. But any reduction today would mark the first back-to-back reduction that we've seen in 13 years. But will it come with any updated guidance, any updated nuance on the pathway from here? The market very much setting up for more reductions to come down the track. Some saying until June next year they see further rate reductions. Also question as to where we end up at a terminal level and where the neutral rate sits in Europe versus, say, even the United States. I think dramatic that we've got more cuts anticipated for the Fed at this point in the cycle than versus the ECB, despite the weaker profile. But the numbers are about to hit the tape, and if we look at what we're seeing on the ECB deposit rate this morning, that is 3.25%. We have seen a 25 basis point rate reduction now delivered from the ECB on that deposit facility. So there we go, 3.25% is where we're perched. The benchmark refinancing rate, that has been moved to 3.40% versus 3.65%, so reduction there as well. The margin lending facility today is also something we're watching very closely for you. That is at 3.65 versus 3.9%. So movement on these three main interest rates, all lowered by 25 basis points here. The inflation outlook is also affected by recent downside surprises and indications of economic activity. This line crossing from the ECB, saying meanwhile financing conditions remain restrictive. So a nod to those financing conditions from the ECB. Domestic inflation, they're also talking about that. Inflation outlook is also affected by recent downside surprises and indications on economic activity. Domestic inflation remains high as wages are still rising at an elevated pace. Not pre-committing to a particular rate path. Let me get out to Annetta for more on this and some immediate reaction to what we're seeing crossing the tape. Annetta.
Well, it was pretty much, or it is pretty much in line with what we were expecting, I guess, if you look at the explanation, and also that they reinstate and really stress the fact that they're not going to pre-commit on any further rate cutting or rate path, so they will stay data dependent, which makes it, of course, more difficult for the market to read the decisions ahead from the ECB. But there's a big but as well. They're also saying they see inflation coming back to target during the course of next year, and that their policy stands still. Financial conditions are still restrictive. That means that if we get more negative surprises, which they are also admitting that the economy is actually doing worse than expected. The sentence is the inflation outlook is also affected by recent downside surprises in indicators of economic activity, meaning, of course, that this has been a surprise to the ECB that the euro area economy is doing actually worse than previously expected, and that this has a bearing as well on the inflation outlook. But I guess that they are stressing that wage levels or wage developments are still rising at an elevated pace makes them still cautious. But being cautious, of course, is right, but they need to consider the time lag of policy action as well. And that is what they're doing. Even Isabel Schnabel, who has been very, very hawkish when it comes to interest rates cuts, in a recent speech even was pondering that idea of that there is a possibility of inflation overshooting, so that you literally kill the patient with your medicine. And that is, I think, a thinking which has clearly arrived inside the governing council. So having said that, I guess at least for the next policy meeting, if there is no big oil price shock or anything else, I think what is clear is that the ECB will look through that picking up of inflation towards the end of the year. They have been telling us this story various times, that inflation is going to pick up during the course of, or towards the end of this year, because of base effects, that they will look through that sort of noise and they will keep cutting. And I think that's the message here. Whether this is another 25 or 50 basis point cut probably will very much depend on whether we get more negative surprises from the economy, and whether perhaps also wage pressure is abating, and whether the inflation rate might not shoot up as much as they are expecting. So in a nutshell, of course, the ECB is operating in a very uncertain environment, but the path is clear. But these key questions you were raising, Karen, where is the neutral rate? What's the terminal rate? Which sequence they are looking at, and what economic indicators are most important for them. I think these are all questions we try to get an idea of, or an answer to, during the press conference, which will be happening right now behind me at 2:45.
That is a good point, isn't it, Netta? We didn't get any clarity of that in the statement that we were pouring through this hour. Thank you very much for giving us some instant reaction there. I've also still got Mariana Sina, who is Senior European Economist, Barclays Investment Bank. What's your reaction? You've been scanning through the text as well. They're still talking about financing conditions remaining restrictive and inflation expected to rise in coming months.
I think that this is pretty much in line with what we were expecting. I think that the strategy that is to remain, I think, nimble and move meeting by meeting, at least on this year, is that on the inflation side, I think that there's some interesting things that they, for example, acknowledge that inflation, the pace of this inflation has accelerated due to weak economic conditions. So I think that this is an acknowledgement, as you say, that restrictive monetary policy is having an impact on inflation and probably is accelerating the level of this inflation.
Is the headline inflation number going to get away from them to an extent? Because we've got a base effect kicking in around the energy price, which should put some pressure back into inflation, yet the unwind we're seeing on the economy that they've alluded to could have an undertow. So how do we think about whether, in fact, there will be a lift-off in inflation over the course of the rest of this year?
I think that mechanically there will be, is that an upgrade on inflation is that by the end of the year, and that's why they have communicated in advance that probably we should ignore it. But then I think that, as you said, is going into next year, is that the key forces that are the permanent ones that will be driving inflation lower, and that is weaker economic activity.
The inflation number always surprises me in the sense that, you know, we're setting policy for a very wide number of countries here, but the inflation rate is so different in each of these countries. And we saw that magnified today. What you've got Ireland, 0% on the annual inflation rate versus the likes of Belgium and Poland ticking above 4%.
Yes.
How on earth can one policy fit all in this context?
Well, that's the art and the difficulties of the ECB, and that's why I think that they have to remain, data dependent. Is that last year Spain had inflation below target at 2%, then it went back to 4%, and now it's below back 2%. So it's very difficult to manage, but I think that that's why they look at the aggregate and they try to ignore to the extent possible what's going on at the country level.
There's been some airtime in this text today about the unwind and the economic outlook story, the growth profile that we've been talking about. But I was reading an ING report that came out yesterday questioning whether some in the market are too downbeat around economic growth, which I thought was fascinating because we've been hearing a lot about that. They're saying the ZEW saw a somewhat bigger improvement in expectations component than anticipated. The ECB's own lending survey has shown some cautious improvements. Is there anything to that, or should we actually be pessimistic?
I think that is that clearly what the bank lending survey shows is that easing of monetary policy will help to revive lending flows into the economy. But when you look at high frequency indicators, is that the September ones were pretty dismal. They went back into contractionary territory. So I think that we take signal from that clearly there's a sign that the economy is decelerating rather than accelerating, as it should be expected at this time of the year, so late.
Well, as we're talking about the direction and where we're heading, this runway towards some sort of lower interest rate, where is terminal in your view, and where is neutral?
Well, I think that in this cycle, our view is that terminal and neutral is going to be the same, so that the ECB will not be behind the curve. So probably they will not need to move policy into an accommodative stance. And our view is neutral is around 2%. Is that nominally? Is that with risk that it could be even lower? So is that we still have a trajectory from today is that 125 basis points to get us there.
The lack of guidance today that is coming through loud and clear, data dependent, meeting by meeting, but the reality is we have strayed from quarterly rate cuts now to monthly ones, and we do wonder whether the next step is some sort of conversation on jawboning and giving us more clarity on the direction. Is it a case of once bitten, twice shy for the Governing Council? Because they did give us guidance early in the year. They sort of boxed themselves into this meeting. Are they now worried that they're going to take away their optionality if they give us more clarity?
I think that clearly that is the point, is that they also learned the lesson from April, where they strongly almost hint that there was a cut coming in June, and then probably some of them regret. But there's a point, is that particularly when you are approaching, is that whatever is the estimate of neutral, that you need to become a bit more forward-looking and maybe base your decisions on your forecast. Is that right now, I think that they are comfortable because they know that policy is quite restrictive, so they still have some space to cover and they won't be making a mistake. So we expect that probably by the December meeting, when you extend the forecast into 2027, is that there could be a tweak in the guidance in the language.
I want to ask you about financing conditions, because the text that's hit the tape short time ago says financing conditions remain restricted. And as we look at earnings, we're seeing that some companies are struggling with financing costs. Many have tried, of course, to front load this and get ahead of any rate hikes, and they're locked in a lot of financing. But others are finding it difficult to try and compete in a marketplace where there's more competition, but yet they still have a higher interest rate to try and cover. At what point do you think those financing conditions start to alleviate or lessen to an extent because the market starts to reprice expectations?
Well, I think that we still will need to ease policy, I would say, significantly from here to have a strong impact, I would say, on the corporate side. I think on the household side, we are already seeing it with applications for loans and mortgages and the bank lending service showing that houses are becoming a bit more, I think, that enthusiastic about borrowing. But on the corporate side is that basically net flows have been stagnant for 2 years, and there's no signs of a revival there.
I wanted to get to what we're seeing in terms of the wages side, because this has been a thorn in the side of a lot of central banks, and it has been for the ECB as well. Is that something that we need to think about from here on in, or are we really done in terms of some of those higher prices? Because we've had an inflation number today, 1.7%. How on earth do you go and argue to your employer that you want those large size increases between 5 and 10% when the overall inflation rate is now 1.7%?
Look, at Barclays is research. We have always been of the view that the rise in wages was a bit of a catch-up story, is that to pass inflation, and we think that this process is mostly done or complete or will be finished, over the next few quarters. And then when we look at, what's going to be the forward drivers of wages, and we see an economy that is basically stagnant, a labor market that is softening, inflation expectations are anchored, and we see everything aligned for a normalization on wages. So it's that we are less worried than maybe some of the policymakers on wage developments.
Mariana, thank you very much for joining us today. We are all closely watching this press conference now. I think the FX traders fell asleep while they're looking at this news. They did absolutely nothing with euro dollar. Thank you very much for joining us today. We do appreciate your analysis. Mariana is now with us, who's senior European economist at Barclays Investment Bank. Well, stay tuned. We'll have more reaction to the ECB's latest decision after the break, and we will bring you Christine Lagarde's press conference that is live 14:45 CET.
The Shiseido creativity, I admired it. It has a history of 100 years old. Even before the word in-house became a thing in this industry and market, a century ago, Shiseido already had it. The emotional connection, the science behind it, Shiseido is great at, and they've been telling this story at least in the past decade. But the emotional side is missing, and there's so much storytelling that we can do on top of the many great things we already have through products or even the brand message. We were really well known for handcrafting things very much for a long time, but the communication side, it needs to be updated. Especially with all these social media and other touch points, and not just for the new generation, people in their 50s and 60s. So the way we have to communicate using these skill sets that we already have needs to be updated.
CNBC, live ambitiously. Frank Holland, Worldwide Exchange, CNBC.
If you're really ambitious, you don't think about the end goal. You're too busy thinking about the process of getting there and the growth that you need to achieve. And nothing can beat that.
Welcome back to Decision Time. I'm Karen Cho. Look at what we've seen from the ECB today, a 25 basis point rate reduction on its three main interest rates. So we have seen now the first back-to-back rate reduction in 13 years. Quarterly moves have now given way to monthly moves, but the ECB still remaining data dependent, not giving us any further guidance here. We've seen barely any reaction on the market. I dare say everybody's waiting up for this press conference from Christine Lagarde. So bonds ticked up slightly. We've barely seen any movement really on the exchange rate as well. So we're pretty much flat as a pancake. So the market is now seeing an ECB, a central bank that is concerned about the growth rates. That seems to be the message that is coming through. And don't forget the powerhouse of Germany. We've been reporting on this a lot. The weakness that is playing out, that there is no recovery in sight. Weakness cropping up too in other manufacturing hubs across Europe, and some of those manufacturing hubs infecting the services side of the economy. So the ECB is very much now responding to that growth profile. And in its text today, it's been talking about some of the tight financing conditions across here in Europe as well. So what we're seeing in terms of the euro-dollar trade, we're 108.46. Actually, we're just tilted a little bit lower now as we creep down to the press conference. So we're giving back a little bit of territory here, and perhaps that is, again, some early positioning about whether we do get some clarity around neutral rates, terminal rates, and what sort of conditions the ECB is watching. Domestic inflation remains high, though, so despite the fact we had the unemployment rate coming at 1.7% today, there's still a nod to some sort of inflation story playing out. And don't forget, wages have still been a higher component. We're still not back on track around services, even though there's been a deceleration there. And of course, the ECB looking at some base effects that could kick in that moves the needle on those energy prices later this year. So those are still elements, but that line, domestic inflation remains high, is still an interesting line in the text. To the 10-year yields. As we take stock now, you can see all of the yields creeping up slightly. The Italian paper was trading down, but even now that is now managed to move into green territory. So we're 2.21 on bonds. Let's see whether we stray from that level on the benchmark, one of the rates here in Europe as the press conference begins. European markets very much focusing on the earnings in the first half of this trading session, from the likes of Nestle to Pernod Ricard to Nokia to what we're now seeing as the macro kicks into gear this afternoon with the ECB. French stocks are pulling forward. We're up about 1.1 now, 1.3%, 1.2 on the Italian market. And you can see stocks out of Germany rallying about 0.8%. So staying firmly in positive territory is what we're watching. The banks in reaction to that change. And don't forget, there is that real tug of war of NIMs, the net interest margins, being impacted by lower rates versus any improvement in volumes on the demand side as we talk about lower rates. So for those European banks today, it can be a mixed picture. It has been very much a sweet spot for the European banks to date, and whether any of the guidance we get or any of the statements from the press conference moves the needle on these banks, where there's also been, of course, consolidation talk as we talk about a backdrop that could be slightly tougher for the banks from here on in. BNP Paribas stronger, 1.8% higher. Deutsche Bank up 1%, 1.4% on Commerzbank. UniCredit 1.25%, and about 0.8 up on Santander. So it is a rally right across the banking names. Let's get to Ben Emons, who is Chief Investment Officer and founder at FedWatch Advisors. Ben, thank you very much for joining us. We are now seeing a little bit more distance between the ECB interest rates on the deposit rate versus the Fed funds rate. What do you make of the decision today?
It was largely as expected, but I think to your point earlier in the segment, this ECB is obviously on guard, right, for this inflation outlook. It's really driving this decision again today. That's in the text. But they also want to make sure that the strength of their monetary transmission stays intact too, because if this is an uneven recovery and a recovery there where there's still actually lingering inflation risk in the future, they can't just lower rates so fast, so quickly. So I think they're responding to the latest decline in inflation, but they remain this data dependent, because if they lock themselves into a series of rate cuts, inflation goes the other direction, given that what's playing out in the Middle East, for example, then they're behind the curve, right? So I think the ECB delivered what was expected by seeing this muted reaction in markets, but it still remains a data-dependent ECB, which keeps us on edge, I think, and will add to some volatility in sovereign spreads and equities.
And I can see an instant reaction on wires that some are having a bit of a gripe that the ECB hasn't changed its language in the statement. They thought, like, given the fact that we've now had third cut in 4 months, that there would be some acknowledgement that we've changed from one pathway to the next, more of an easing cycle here, but they haven't dropped the language, not on a particular rate path language from the statement. What do you make of that? Is it time to rip up the old text and come up with something new?
Yeah, you would think that they would go to forward guidance then, and it's just really giving markets more specific future guidance, even though they did give guidance for this, interestingly, for this meeting. So I think they're just not there yet. They remain, I think, wary, just like the Fed is wary and other central banks are wary of, like, how's this global shock really playing out post-pandemic? You know, we're still seeing reverberations through supply chains, through different markets, including commodity markets. So I think that keeps them just very cautious here, just not really willing to commit to this rate path that people are calling for, even though if you look at the inflation numbers today, and including all the sticky numbers, really shows a glide path down. You extrapolate that out, you would actually get to much lower rates from here. So I think the ECB is just sort of at a stage of saying, we see that, we recognize that this inflation is going our way, but just want to make sure we really reach that number, that 2% price stability. That's why I think they stay away from forward guidance.
Ben, I've got to say the market very much looking for some signals as to where they're going, how quickly they're going, where they're going to end up. I mean, JP Morgan was talking about a shallower cutting path here for the ECB versus the Fed before this meeting. 175 basis points priced in by the markets versus 200 basis points for the Fed, which is just extraordinary when you consider the weaker growth profile in Europe versus the United States. Do you think there is some room for the markets to position around fixed income, that there might have to be more moves from the ECB than what's priced in?
Yeah, I think so. I mean, there's certainly opportunity in the intermediate part of the yield curve. I think many recognize that opportunity because ultimately easing cycle leads to a normalization of the yield curve. That's been the biggest issue for fixed income the last 2 years. An inverted yield curve only gives you like real interest on the front end of the curve, but a lot of volatility on the back end. So as it sort of normalizes, the intermediate part becomes interesting as this, what we call carry roll down, return ahead of us. But I also would say that there's still volatility left in fixed income simply because of the range of outcomes. So as you say, like there's a difference in pricing that could very well quickly narrow or widen again. So I think playing it in the intermediate part is more safer, I think, than sitting on the long end of the curve. Whereas the front end is clearly locked into, well, ultimately there will be lower rates, so there will be less return at some point. So I think fixed income is in a good position here. We're not dealing with really like the surge of inflation, but if financial conditions stay this loose with rates lower, economies will stay at least on track to grow. So recession risk is not there either, which means that 5-year yields will not go materially, like significantly lower, but there's more like a yield curve play there. And I think that's the opportunity.
Ben, if we change the players over at the ECB Governing Council for the Fed, do you think we would have seen a different announcement today, a different decision, maybe 50 basis points, a jumbo size reduction?
Well, that could be, but I think that too, that the jumbo size reduction was a maybe potentially a one-off, simply because if you really think of what's going on the US side, they forecast a higher unemployment rate by the end of the year than where the employment rate currently is. So they're on alert, on guard, that there's a deterioration in the labor market. They want to get ahead of that problem. I think that's why they did the jumbo size cut. But in the case of the ECB, it's a different story. We should talk about price stability here of 2%, that they're essentially getting close to, and therefore not really needed to do these big cuts, more like reducing rates so that you assure that price stability. But yeah, data dependent by meeting, not giving forward guidance. So I think the jumbo size is there, it's possible, but I think it's the Fed case if the unemployment rate does go up towards their projection. And that's to be seen here as we play out with all these storms and port strikes and everything else. Waller said, we're going to get a big distortion in our payroll number, about 100,000 at least. So that will be really setting expectations for the November meeting. The Fed may have to move faster just to control that situation. Don't think the ECB is at all in that position.
Ben, the central bankers are the first to admit that things can happen beyond their remit. And we've seen a market event in August that seemed to change prospects around monetary policy. We had a market event volatility in September. Now, as we count down to year end, the big elephant in the room is a US election and whether we could see a market roiled or rattled by this event. What do you make of the prospect for more volatility with consequences in coming weeks?
that's all about how the election ultimately will play out in terms of the policy agenda. It's interesting to see in financial markets in the US that people have expectations that Congress may be Republican, and also what they call the red sweep. That seems to be very consistently priced in, whereas the volatility on who will be the ultimate winner of the election is quite high, and that's because of the swings of polls, and people cannot really make of it who will really have the edge here at this point. It really comes down to the day itself. But we know what will happen after that, once we have a winner, is that either we're going to go towards a major direction in terms of trade, very different sort of environment that we're in currently, is in trade war, or we're getting the same, but maybe somewhat more focus on domestic investment through infrastructure under a Harris administration. I think that's still sort of where the markets try to toss with. So people play it safe, say, well, Republican Congress is quite likely. That seems to be favoring certain parts of the market that are in position for that, whereas Democratic Congress doesn't seem likely.
And thank you very much for the analysis and for joining us on the back of the ECB decision today. Ben Edmonds with us, Chief Investment Officer and founder FedWatch Advisors. Well, stay tuned. More exciting news coming your way. We will bring you Christine Lagarde's press conference next.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
CNBC. Live ambitiously.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
We are awaiting ECB President Christine Lagarde, who is due to deliver her press conference shortly. Just to remind you of the action we've had so far, all three of the main interest rates in Europe have been reduced. The deposit facility now 3.25%, down from 3.5%. The benchmark refinancing rate 3.4% versus 3.65%. And the marginal lending facility, that now stands at 3.65% after being reduced from 3.9%. So move on all of these. The inflation outlook, though, is affected by recent downside surprises in indications of economic activity. So the read on this is that the ECB is looking at the unwinding growth. So what exactly it says about the growth outlook in Europe is going to be key at this meeting. It says financing conditions remain restrictive. Domestic inflation remains high as wages are still rising at an elevated pace. I think the market will be probing on this, and journalists during this press conference, because we saw the euro area inflation rate hit 1.7%. That crossing the tape today versus 2.2% even a month prior. So the declines we're seeing here, how much of that sticks around, and what we see in terms of any base effects on the energy side and where we go to from here. The ECB went on to say it will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim, and it is not pre-committing to a particular rate path. Now, the market was looking to see whether there would be any difference in language here in the text, that it has been somewhat cautious around its options and boxing itself in after its first rate decision. And this cutting cycle was very much flagged to the markets, and then conditions seemed to change and it was really stuck with that rate reduction. So the market really not getting much of a steer now on what it decides from here on in, because that optionality is seen as all important for the ECB Governing Council. But I must say that earlier in the year, when I did speak to a lot of the policymakers in person in Washington, they were starting to become more concerned about the growth outlook, particularly if they were positioned quite close to the border with Ukraine. They were concerned about whether any turn of events around the war in Ukraine would impact sentiment in Europe. And of course, we're still talking about a lot of conflicts globally. And of course, we're still watching the oil price, which energy prices again taking off in recent weeks around the Middle East conflict. So that is still a wild card. But that said, these wage negotiations, are they more rearview mirror now as we see that inflation rate come down? And in many of these countries that manufacturing has been so weak, it's now starting to impact the services side. All important, the neutral rate, any communication on that, where we see that going, whether 2% is the terminal rate and whether 2% is also the neutral rate. Don't forget, in previous cycles, we've gotten below the neutral rate with some accommodation required, but the market thinks that being delicately perched between some sort of expansion contraction level is where we're going to end up, whether any of that is communicated at this press conference today. So it will be the subtleties. You're going to have to listen very closely. And don't forget, we haven't seen a huge amount of movement in FX markets on the back of this decision today, or indeed on bonds. So that is something we're looking for in terms of any further repositioning. So a couple of final photos being taken here, as you can see, as we get set up for this press conference that is about to begin. So ECB's Christine Lagarde due to be speaking here on the ground in Slovenia, where of course inflation is towards the low end. It's all very different across these various different countries. 0.7% in Slovenia, along with Italy, well and truly away from Poland and Belgium, where we're sitting above 4%. So these are levels that are quite different across the bloc. I believe we're going to be listening into this, and we may take this conversation for you live now.
This year's external governing council meeting. Slovenia is a member state with the highest support of the euro, and having President Lagarde, Vice President, and my dear colleagues, governors here in Ljubljana, to discuss monetary policy and to adopt the decision will further strengthen this trust and support to the euro project. And this is exactly the idea which is behind us organizing our main policy meeting outside Frankfurt once per year.
Thank you very much, Governor. Next to me is President Lagarde, and at the end, Vice President de Guindos. My name is Wolfgang Preußel. We have participants who join us remotely, so if they ask questions, I would ask them to turn on the camera and the microphones. And with that, I give the floor to you, President Lagarde.
Thank you so much. And I would preface my usual monetary policy statement address by a great thank you and the expression of our collective gratitude to you, Boštjan, to all the staff of the Central Bank of Slovenia, and to all the Slovenian authorities and the Slovenian people. We've been beautifully greeted, and it's a real pleasure to have spent the last 2 days here in your company and in Ljubljana. With that, good afternoon to all of you. The Vice President and I welcome you to our press conference. Again, thank you, Boštjan, Governor Valle, for your kind of hospitality, and thank you for your welcome, and we express all our gratitude to your staff, some of whom are present in this room, actually. The Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate the rate through which we steer the monetary policy stance, is based on our updated state assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The incoming information on inflation shows that the disinflationary process is well on track. The inflation outlook is also affected by recent downside surprises in indicators of economic activity. Meanwhile, financing conditions remain restrictive. Inflation is expected to rise in the coming months before declining to target in the course of next year. Domestic inflation remains high as wages are still rising at an elevated pace. At the same time, labour cost pressures are set to continue easing gradually, with profit partially buffering their impact on inflation. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the incoming information suggests that economic activity has been somewhat weaker than expected. While industrial production has been particularly volatile over the summer months, surveys indicate that manufacturing has continued to contract. For services, surveys show an uptick in August, likely supported by a strong summer tourism season, but the latest data point to more sluggish growth. Businesses are expanding their investment only slowly, while housing investment continues to fall. Exports have weakened, especially for goods. Although incomes rose in the second quarter, households consumed less, contrary to expectations. The saving rate stood at 15.7% in the second quarter, well above the pre-pandemic average of 12.9%. At the same time, recent survey evidence points to a gradual recovery in household spending. The labour market remains resilient. The unemployment rate stayed at its historical low of 6.4% in August. However, surveys point to slowing employment growth and a further moderation in the demand for labour. We expect the economy to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should contribute to the recovery as global demand rises. Fiscal and structural policies should be aimed at making the economy more productive, competitive, and resilient. That would help to raise potential growth and reduce price pressure in the medium term. To this end, it is crucial to swiftly follow up with concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and Enrico Letta's proposals for empowering the single market. Implementing the EU's revised economic governance framework fully, transparently, and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Governments should now make a strong start in this direction in their medium-term plans for fiscal and structural policies. Annual inflation fell further to 1.7% in September, its lowest level since April 2021. Energy prices dropped sharply at an annual rate of minus 6.1%. Food price inflation went up slightly to 2.4%. Goods inflation remained subdued at 0.4%, while services inflation edged down to 3.9%. Most measures of underlying inflation either declined or were unchanged. Domestic inflation is still elevated as wage pressures in the euro area remain strong. Negotiated wage growth will remain high and volatile for the rest of the year, given the significant role of one-off payments and the staggered nature of wage adjustments. Inflation is expected to rise in the coming months, partly because previous sharp falls in energy prices will drop out of the annual rates. Inflation should then decline to target in the course of next year. The disinflation process should be supported by easing labour cost pressures and the past monetary policy tightening gradually feeding through to consumer prices. Most measures of longer-term inflation expectations stand at around 2%. Turning now to our risk assessment. The risks to economic growth remain tilted to the downside. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by sources of geopolitical risk, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could also disrupt energy supplies and global trade. Lower demand for euro area exports due, for instance, to a weaker world economy or an escalation in trade tensions between major economies would further weigh on euro area growth. Growth could also be lower if the lagged effects of monetary policy tightening turn out stronger than expected. Growth could be higher if the world economy grows more strongly than expected, or if easier financing conditions and declining inflation lead to a faster rebound in consumption and investment. Inflation could turn out higher than anticipated if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push up energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. So looking at the financial and monetary conditions, shorter-term market interest rates have declined since our September meeting, owing mainly to weaker news on the euro area economy and the further fall in inflation. While financing conditions remain restrictive, the average interest rates on new loans to firms and on new mortgages were down slightly in August, to 5% and 3.7% respectively. Credit standards for business loans were unchanged in the third quarter, as reported in our latest bank lending survey, after more than 2 years of progressive tightening. Moreover, demand for loans by firms rose for the first time in 2 years. Overall, lending to firms continues to be subdued, growing at an annual rate of 0.8% in August. Credit standards for mortgages eased for the third quarter in a row, owing especially to greater competition among banks. Lower interest rates and better housing market prospects led to a strong increase in the demand for mortgages. In line with this, mortgage lending picked up slightly, growing at an annual rate of 0.6%. So to conclude, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
So the first question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Thanks for taking my question. My first one would be on the next steps. So it sounds like you expect to reach a 2% target maybe sooner than predicted in September. Does the decision to cut today really represent a shift of gear? Do you expect a cut at every meeting for the next few meetings now to be the most likely scenario? And the second question would be on the US election. So you mentioned trade tensions as a risk, but can you elaborate how you think a return of Donald Trump to the White House and his plan to impose tariffs would alter the outlook for growth and inflation in the euro area?
Well, thank you so much for your question. We decided to cut all our rates by 25 basis points because we believe that the disinflationary process is well on track. And all the information that we received in the last 5 weeks since our last monetary policy decision were heading in the same direction, lower. Whether you looked at inflation numbers, headline, core, whether you looked at PMI numbers, all categories, composite manufacturing, services, employment, heading downwards as well. If we look at all the surveys that are in the works at the moment, of which the specific numbers and data will be available soon, it is the same story. Whether it's the corporate telephone survey or other surveys that we have available, it's all heading in the same direction, downwards. And that really confirmed for us the confidence that we have that the disinflationary process is well on track. That is what has caused us to make the decision to cut our 3 rates by 25 basis points. We have also reiterated that we will continue to be data dependent. And honestly, this decision is a case in point of us being data dependent. We have all the available data, all heading in the same direction. The largest countries all also moving in negative territories in PMI numbers. So those are really strong elements because of their synchronization and the similar direction that we have to take into account those data and make the decision that we have made. But we are going to continue doing exactly the same thing. And it's clear that between this meeting and the next meeting we have in December, we will be receiving more data, some of it soft, some of it hard, and more readings. And all of that will help us decide, as I have said, meeting by meeting, what monetary policy stance we should decide at that time. So I think there was no variations in that respect from decision that we made in the past in terms of methodology. It's the same steer, the same stance, the three-pronged approach, and the meeting by meeting data dependency, no predetermined path. So on the other point that you raised, trade is obviously an important element, and as part of the drivers of activity going forward, we obviously have consumption and investment, but we also have trade. And any restriction, any uncertainty, any obstacles to trade matters for an economy like the European economy, which is very open. Trades within itself, of course, but trades also with the rest of the world. So any hardening of the barriers, the tariffs, the additional obstacles on that possibility to trade with the rest of the world is obviously a downside.
Thank you. Next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you. Thank you. Hi. My first question would be on the economic outlook. So you were now referring and pointing out that the economy really doesn't really look great and all signs point towards more downspin. Why don't you go for a 50 basis point cut? And is that something you have discussed, or whether this is on the table for the next ones? And have you been discussing the topic of the possibility that inflation could also undershoot if you keep your policy stance restrictive? Thank you.
Well, thank you very much for your question. It is a fact that the economic activity has come in on the basis of the element that we have and the indicators that are available, has come in a bit below what we had anticipated. But this is not a projection exercise. We are in between two projection exercises, and clearly December will be another opportunity for us to, run all the data, all the information through our model, and to apply the three-prong approach to our stance. What was on the table and what was debated and proposed by our chief economist, Philip Lane, was a 25 basis points cut. End of the story. We had discussions and debates and rationale and narratives, and all of that is part of the debate and the legitimate discussions that we have within the Governing Council. But at the end of the day, there was a unanimous decision to cut rates by 25 basis points. It may have been the Slovenian great atmosphere that precipitated this not more than consensus. There was unanimous decision to cut by 25 basis points, and we thought that it was the appropriate decision to make in view of the moment, in view of the indicators that we have, and our assessment of this disinflationary process that is really underway and well on track. That's really what. Risk of undershooting, risk of overshooting, we can debate ad nauseum on this particular matter, and you will find views on both sides of the equation. I think, what is clear to all is that we still have risks on both sides of our forecast, upside and downside, probably a bit more on one than the other, probably more downside risk than upside risk, but I'm talking here about our forecast for inflation, and that's what we are looking at.
And the next question goes to Aude Kersulek of BFM Business. Aude, please.
Bonjour.
Thank you for taking my questions. Inflation is expected to reach a target in the course of next year instead of at the end. Will we reach neutral rate earlier than before? How will you recalibrate monetary policy on cuts to come? And second question, is German economy the main reason for the shift since September, when the today's cut was unlikely, or at least is it a good reason?
First of all, we don't recalibrate, we calibrate. And this is really the process through which we go. As laborious as it is, we believe in our three-pronged approach. I won't bore you with the repetition of it all, but it's inflation outlook, underlying inflation and transmission. And we calibrate our monetary policy on the basis of all the data that is available and applying that three-pronged approach. Now, it's obvious that the state of the economy and the activity has a bearing on inflation. And to that extent, of course, we take that into account in order to assess inflation and its return in a timely manner to our target. But that's the extent of our consideration, the bearing of activity on inflation, because our job is price stability and our mission is to return inflation back to 2% target in the medium term.
Turning to our online participants, the next question goes to Olaf Storbeck of the Financial Times. Olaf, please. You are... Yes, please go ahead. You are unmuted now. I'm sorry, we can't hear you. You seem to be talking, but there's no voice here. We let you sort that out, and then I would go to Jean-Philippe Lacour of AFP. Jean-Philippe, please.
Hello, hello. Can you hear me?
Yep.
Very good.
We can't see you, but we can hear you.
You can hear me?
Yeah, and now we can see you as well.
Okay, very good. Thank you very much. Good afternoon, Madame la Présidente. I have two questions. So you said earlier we will have more data in December, not much more, but more data. And if they all point in the same direction as you outlined earlier as well, so you will just have opened the door widely for a new rate cut in December, if I interpret you well. And the second question, you mentioned the tensions in the Middle East that could feed inflation through the energy prices. What about domestic stimulus in China, which is huge and could also revive pressures on energy prices through domestic demand and then feed the inflation? Is it something that you will combine with those Middle East tensions, look very carefully at in the next months?
Well, thank you very much for your two questions. It is a fact that at each projection exercise, we receive more data, and in particular, more updated projections, of course. And typically, given that between now and the December meeting, there will be more than 6 weeks, we will also receive more data. And as I said, I did not open the door to anything. I repeated that at each and every meeting, we will look at the data, hence we will be data dependent, not data point dependent, nor anything else, data dependent, all of it. We will determine what is the best rate, what is the best speed, how far, how deep we have to go in order to return inflation to its 2% medium-term target. This is what we will do in December, and I would not, give any other commitment, nor make any other statement in that respect. As I said in the monetary policy statement that I read earlier on, we are not pre-committing. And again, I think that the decision that we're making today is a perfect example of how we can be data dependent. You refer to two areas of big concern, one coupled with obviously a major conflict and a horrifying one that is taking place in the Middle East. We, of course, are concerned beyond the humanitarian approach, beyond the conflict aspects. We are looking at the economic consequences. And we are looking in particular at the impact that this conflict could have on trade, because that part of the world is very much open to trade and the passing of ships of all sorts. We are also very attentive to the price of oil that can be impacted. And this oil price is a good segue into your question about China. What will happen in China, what kind of stimulus will be activated with all full details as is expected at some stage, will also be an indication of the demand addressed by China to the oil market and the impact that it will have on the price of such commodity. So we are looking at all those components and obviously focusing on the economic consequences and the impact that it could have on inflation and obviously activity to the extent that it impacts on inflation. Thank you.
I don't see Olaf Storbeck, but he has perhaps connection problems, so we will return to him later. Balazs Korani of Reuters. Balazs, the floor is yours, please.
Good afternoon, and thank you so much for taking my questions. The first one is about economic growth. President Lagarde, is a soft landing still your main scenario? And am I correct to see that perhaps your attention has shifted slightly from inflation concerns to growth concerns? The second question is about a line in the statement which says the rate is still restrictive. But I'm curious, we thought, restrictive is this unobservable concept because we don't know what the neutral rate is. But perhaps maybe you started having a discussion in the Governing Council on where does restrictive stop? So I'm curious if you have any thoughts about where does restriction end and where does accommodation begin?
Well, thank you so much for your two questions. On the issue of economic growth, are we still on a soft landing expectations? The answer is, on the basis of the information that we have, we certainly do not see a recession. So the euro area, on the basis of what we have, is not heading for recession. And we are still looking at that soft landing that you have just mentioned. Now, you asked me whether we are more concerned about growth than we are about inflation. I would say that we are concerned about growth to the extent that it has an impact on inflation. And we have to be particularly attentive to both, but one, because of the impact that it has on inflation, which is our main focus and our key objective, as you know. So there is, and you pointed to it, that sentence which is sort of the magic language, and I'm sure that you will be very attentive if and when that magic language changes a bit. We still say we will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim, which refers to the previous sentence, which is we are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. So there is no question in our mind that we are currently restrictive. Hence that sentence. There is also no question on our mind that we are not yet at this 2% target. I just want to give you the exact wording, to our 2% medium-term target in a timely manner. And this has to be sustainable. So even if it could well be, as markets anticipate, but they are not always right, that the time at which we reach that 2% sustainably has advanced a bit, but it is not yet now. And we will have to wait further in order to make sure that we are at that 2% sustainable medium-term target. Thank you.
Olaf Storbeck of the FT.
ECB President Christine Lagarde there speaking to journalists. Just a couple of takeaway messages. A lot of questions being fielded. And first up, of course, December is no slam dunk. That Christine Lagarde and co did not open the door to that. They have not pre-committed to anything. So we have a live meeting potentially. We don't know if there's going to be a further follow-up rate reduction. Don't forget the market, though, is placing its bets that there will be another rate reduction in December. In fact, they continue to price out expectations of reductions. This is what we're seeing in terms of euro dollar. We are seeing some moves here. We were pretty flat on the back of the text that was released to the market while the press conference has been unfolding. You can see euro dollar is now sliding by about 1/3%, 108.22. The comments from Christine Lagarde is that they are still anticipating a soft landing. So what we are seeing here, no expectations of a recession. That said, the ECB closely watching for any slowdown in growth in terms of how it impacts inflation. For me, the tone on inflation was incredibly interesting, that they are still looking at scenarios to the upside, but also the downside. So these are very wide open in terms of the ranges. But over the next 6 weeks before we get to the next meeting, there is still a truckload of data, it seems, and those projections for the ECB will be all important for growth and inflation. The 10-year, let's take a look at some of those yields. We were perched higher going into this. The slippage we're now seeing on the Italian paper, 3.39, that is reversing slowly, but these yields were a little bit higher on the back of some of this commentary. And a look at what we're seeing on the equity markets. We were higher in the back of the earnings today in terms of what we're seeing now. The DAX actually rallying a little bit more. We've had a bit more appetite for German stocks on the back of this press conference. So we've gotten through 1% pop now. It was a gain of less than that over the course of most of the session today. French stocks also picking up speed. We're roughly 1.25% before the press conference, now seen up 1.6%. The Italian stock market up 1.3%. That is holding firm, as you can see, but Spanish stocks still showing a little bit of weakening here, but there is certainly some movement on the back of that press conference. And on a quick programming note, we'll be hearing from a flurry of policymakers next week when I travel out to Washington, D.C. for the IMF World Bank annual meetings. We'll be hearing from ECB Governing Council members to European finance ministers. Be sure to tune into the channel for those conversations. Really the next stop after today's meeting. Well, that is it for Decision Time. I'm Karen Shea. We'll hand you back to our colleagues stateside for the start of trade on Wall Street.
This explains so much, Jim.
Yes, I was concussed. That was before the protocol. I came right back. Now I would be out 2 weeks.
How about this report out of Bloomberg that Apple had been working with BYD for years on that now canceled car project?
Well, I mean, and then what surfaced was surfaced. The people